now to our next conversation. Nigeria's economy is navigating a changing landscape, with elevated but declining in inflation, according to NBS data. But pressure on the cost of living is still weighing on households and businesses alike. Central Bank intensifies its fight against inflation. Investors and policymakers are also keeping a close eye on the upcoming U.S. Federal Reserve rate decision. That's today, which could influence capital inflows and foreign exchange dynamics. Today, we discuss the state of Nigeria's economic health and what it means for everyday Nigerians. Joining me for this conversation, we have Professor Joseph Nnanna, as Chief Economist, Development Bank of Nigeria. It's been a while. Great to have you on the show, sir. Good morning.
Good morning, Glady. Lovely to be here today.
Fantastic. It's great to have you. So, how would you assess the current economic health of Nigeria? Would you say we're stabilizing or are risks still, mounting? We've seen inflation there, that's declining trajectory. We've also seen, the MPC, cut rates, this year, but they had to hold in the last meeting. What are you seeing so far?
So I believe growth is broadly recovering because we've observed over the last 3 quarters there's been significant growth, 3.1 or so in Q1, 4.2 in Q2, and now just released 3.98 in Q3. However, while we've seen broad-based growth, it's not necessarily trickling down. So there's a imbalance in terms of the growth. The real question is, are households and MSMEs feeling this growth? So overall, when we take a look at the economy broadly, it's real, growth is happening, but it's uneven. We can take a look at inflation. Since the rebase of GDP in Q1, inflation, we've seen it decelerate continually for about 7 months or so. That said, we now know inflation's around 16% thereabout, but that does not necessarily translate to more money to spend in households. If you take a look at random surveys, you will find that a lot of folks are still feeling the pinch. While food inflation has gradually come down, overall inflation, people generally don't feel like their money is still going further. We take a look at the FX reforms that have occurred. The Nigerian foreign exchange market, for example. The central bank has done some good work in ensuring transparency, credibility, broadly clarity, which has made it easier and narrowed the difference between the parallel market and the official window, so which is also quite useful. It allows manufacturers, businesses broadly to plan. You can also take a look at, broadly speaking, the revenue drive has increased. So fiscal discipline needs to be deepened. It needs to be enhanced. And I say this because debt to GDP ratio is probably hovering above 40%. And the government needs that fiscal space in order to do more. We have external buffers that has improved gradually. We've seen this because the central bank reserves, we've seen, has increased. I think the last I checked was on 46 billion. So that's largely FPI. So we have foreign portfolio investors coming in, which has supported overall the strengthening of the naira. However, we've also seen improvements in oil production. That has become quite useful too. Notwithstanding, when we take a look at, say, households and broadly speaking, their financial fragility, these folks are in pain. But those at the bottom of the pyramid need to feel this uplift. So we need to strengthen, broadly speaking, social protection. And when we take a look at that, I'm referencing automatic stabilizers. The cash transfers needs to be deepened, needs to be targeted, and we have come to age in Nigeria where we have BVN and identifying signals where we know specifically who needs support and who doesn't. We need to be targeted and it needs to be implemented, and dare I say, we need to amplify those who have received and have benefited from it across the 6 geopolitical zone. That way, at least psychologically, the population can feel that the reforms are digging deeper and it's holding firm. So when we take a look at this broadly, we now end with the investor confidence and investor stability. They want to be able to predict the economy. They want to be able to understand the policy implementation. We have to move from policy announcements to productivity gains, productivity outcomes. And that's why I believe sincerely that over time, going into next year, we have to see more productivity to derive a degree of fiscal impact and overall broad-based growth as inclusive, and everyone, when I say everyone, I mean the rising tide should generally lift all boats.
Yeah, and talking about lifting all boats, inequality, that seems to be widening a lot this time. We did get the last data there that showed how many million Nigerians multidimensionally poor, that don't have access to the basics, at this point. Do you think realistically, as we are as a country, do you think we can really get it right, when it comes to stopping the weak, from failing? Is it possible, in your opinion, so far?
So in economics, there's something we call the Gini coefficient. That is the degree, or if you like, inequality. And I believe because in advanced economies, it's already built in to their policies. The fiscal space is built in. So when people lose their jobs, you have unemployment insurance kick in. People get food stamps, or if you like, Medicare, that supports the health and welfare benefits. But overall, here in Nigeria, we are not as mature yet, notwithstanding, dare I say this, the cash transfers that had started last year and continues on has maybe paused for a bit, but we need to highlight those folks and those areas, those regions in the country who have actually received these things. Because a lot of times there's an announcement made, a policy announcement that's made, but yet we don't see a situation whereby it's now followed up to ensure that these folks actually receive these benefits and it's now being put to use. A monitoring approach needs to be taken, and spotlights, or if you like, spot checks, to ensure that these folks are actually using these funds to support their welfare and improve their lifestyle and so on. In the end, do I believe this can be continued? Absolutely. We need to budget for it. Like everything else, we need to budget and ensure we implement and follow up accordingly. The reality is this. We have derived some savings over time because of the reduction in importation of fuel products, petroleum products, I mean. So if we know that, those savings can come in. And that's why I believe sincerely, if we are truly trying to ensure that the reforms are felt and they're entrenched in our system, then definitely I would say that perhaps this can be continued, and we need to ensure that we amplify the areas where it's needed the most, thereby allowing the rest of the country be carried along and feel that, okay, maybe at some point it will get to me. Hope springs eternal, and we need to demonstrate that as a country.
Right, because, definitely with a shock of, fuel prices, definitely we know what Nigerians were used to, paying for fuel, and the Naira, weakening from, 300 to getting to about 1,008, huge shocks, for households at this point. And when you don't have welfare from the government, I guess black tax, that has to cover for it, at this point. And we're seeing that also rising a lot. But let's look at, CBN rate decisions so far. In 2025, we see February 2025, the CBN held rates 27.5. July 2025, MPR was unchanged, 27.5. And we got the September cut there, 50 basis points, then the hold in November. In your opinion, how would you say the CBN has performed, this year, tackling inflation?
The CBN and the MPC, to be specific, need to be commended. And I say this because we have to take a look at where we were coming from. We're coming from a scenario where inflation was running out of control. And as a result, price stability broadly was, quite frankly, erratic. We couldn't plan. Manufacturers couldn't plan for importation of their goods and services and so on. And if we have this play out, we will see uneven growth or lowered growth. That's what we experienced over the past few years. However, with the reforms taking place, transparency in FX, businesses can now plan. The fact of the matter is this: the MPC has done a fantastic job, in my view, in terms of holding the rates firm. And I say this because last time I was on this show, I think we talked about the MPC decision in September, and I had said they should hold. And I said that because we need to hold, at least for the foreseeable future, because we need at least 1 year, at least a year-on-year growth pathway to understand the rebasing effect. Because there's no data, we're comparing different baskets, right? So the MPC would need to understudy to see if, in fact, inflation is actually decelerating at the speed they want it to, and if, in fact, it's still holding true. So the fact that they held this time is no surprise to me. Even though markets thought they wouldn't hold, I suspected they should hold, and they did a fantastic job by doing just that. Notwithstanding, going into next year, I still see a hawkish position, at least for the first quarter. Why? Because at least that gives us a 1 year period now to now compare the same basket of goods and services to align with consumer expectations, investor expectations, and so on. And besides, if you hold, at least you can still say observe treasury rates inched up a bit because it was falling below inflation, quote unquote, of the 16.05%. And you do need to attract FPIs to come in. Where I have to say now is the FDI flow. Foreign direct investment has been low for a long period of time. The real question is, how can we convert FPIs to FDIs? How do we get more foreign direct investments to productive sectors to boost productivity, ultimately allowing inclusive growth to reign supreme? So that should be the next question from the fiscal side they need to respond to, because as far as I'm concerned, the monetary side has done their job in terms of maintaining price stability.
All right, so, definitely we did, reference GDP growth. You have Q2 2025, 4.23%, Q3 2025, 3.98%. And definitely when it comes to, the central bank, the MPC, they're trying to balance, the fight against inflation and also, try not to stifle growth. Do you think they succeeded there in not stifling growth?
So yes, the central bank's core mandate is price stability, meaning interest rates, exchange rates, inflation, price stability. Those three indicators is what they should be looking out for. If you see a situation where, if you will, growth happens, that's very good. The fiscal policy side needs to create industrial policies with incentives that allows the private sector to grow naturally. The fiscal side needs to ensure that they have, if you like, targeted agricultural interventions. They need to see improved logistics, efficiency in the power supply. So all these things I've mentioned rest solely on the fiscal side. If and when this is entrenched, when this is relatively stable, power supply, give power a chance, you will see Nigeria take off. 5, 6, 7, 8, 9% growth will become quite normal because we have the numbers here, we have the diversity here to achieve this. For example, digital trade, the telco sector, if you like, fintech space, and the creative economy. Those four sectors I've just mentioned have the opportunity and the potential to drive inclusive growth and to drive up heavily non-oil revenue. And that's an opportunity that we aren't fully harvesting just yet. And I think, dare I say, we have the opportunity now to key into the African Continental Free Trade Area. That alone creates a window of opportunity for growth and development across the African continent.
All right, let's look at external, influences now. All investors, globally bracing for the U.S. Federal Reserve's rate decision meeting. That's today. We'll get that, the final one, for 2025. How do you see the interplay of inflation and interest rate cuts in the U.S. so far, in 2025?
So in the U.S. right now, the Fed is more. They're probably going to cut. I think the market has priced in around 25 basis points cut, and that allows some degree of growth for the U.S. economy. If you take a look at the jobs market there, month on month, they've been probably churning out 50 to 60,000 jobs, which is very low for the U.S. Notwithstanding, productivity has been still high because the GDP hasn't suffered. I mean, the U.S. will probably close around 2% growth this year or so. And if that's the case, I would have expected it to close much lower because of the Liberation Day tariffs and so on. Again, when we see Fed cutting rates, it has its implications too on overall FPI. Will FPI keep coming in? It's a function of us ensuring our rates are held steady and attractive enough to incentivize foreign portfolio investors to come in. So it's a delicate balance, and I think FPI is important, but FDI is long-term money. We need cool money and not necessarily hot money. A wise man once said, hot money rolled over several times becomes cool money. Again, in my mind, FDI gives you a more elbow room, more planning room, and more time to grow and actually entrench job creation in your country rather than FPI. FPI just gives you enough comfort to stabilize your exchange rate and to cover the necessary import coverage that is required, which is also important too. So it's a balancing act, I think. But the Fed, more or less, I believe they will probably cut rates by 25 basis points.
So I guess you're not expecting any surprise there. At this point, consensus is another cut. But what do you see for forward guidance? Do you think forward guidance might be hawkish?
Well, I think forward guidance should be, and we have to be careful when there are certain key words and phrases Fed Chair Jerome Powell will probably use, will indicate where the future of the Fed will look like in terms of rate cuts in the future. However, you should also remember his tenure is about to come to an end. And President Trump has already indicated who he would like to replace Jerome Powell. I think I read somewhere Kevin Hassett, which is one of his economic advisors or something like that. But I think in the end, it boils down to how he communicates in his statements post the decision at the Federal Open Market Committee meeting today.
All right, investors are definitely bracing for that one. I guess markets are already gyrating, to that. Thank you so much. It was great having your perspective today, Professor Joseph Nnanna, Chief Economist, Development Bank of Nigeria. Thank you so much for coming on the show today.
Thanks for having me, Laddie.